Good afternoon. My name is David Berkowitz. I'm from Value Line Partners, and I'm going to deliver to you today a webinar concerning the latest stock market volatility. I am the Chief Investment Officer. Of Value Line Partners, a Red Bank, New Jersey investment management firm. And let's start. January was one for the record books. Out of the 19 trading days last month, 15 days were characterized by triple-digit moves from the Dow Jones Industrial Average when all was said and done. This was the indice's worst January since 2009. I understand that the market has taken us on a wild ride lately, and while it's never fun to experience volatility, I must remind you that volatility is the value investor's friend. The reason that I'm having this webinar is because the onslaught of daily volatility in both directions, up 2% one day, down 2% the next, is on a scale I don't ever remember seeing in my 30-year plus career. The stock market is beyond manic depressive. It's paranoid schizophrenic. I thought that this extreme volatility may be wearing on you guys, so hence the webinar. I want to stress that the question is not what is causing the market to gyrate wildly. The question, and believe me, the only question that matters to us, is how are we going to react to the volatility? This, in my opinion, is the biggest reason you need a financial advisor in the first place, to help you to continue to act rationally under uncertainty. One of the most important functions of an advisor is to encourage you to continue acting on your financial plan, rather than reacting to the whims of Mr. Market. At the end, I promise to give you 3 things to do right now that will be consistent with maximizing your lifetime returns. And by the way, if you don't have an advisor or you question whether your current advisor is sufficiently encouraging you to embrace the current unpleasantness, then please get a second opinion. On panic mode, as are the markets for such quote-unquote safe investments, also known as dead money, as treasury bonds and gold. I'm therefore duty-bound to mention the fact that as of today, the S&P 500 has just been able to meet the average stock market correction since 1975. And as many of my listeners know, it's 14% is the number. And again, that is nothing more than the average intra-year correction since 1975. So you got to wonder, what is the big deal? After tripling it, great panic lows in 6 years amid humongous earnings gains, the S&P 500, together with its earnings, is taking a well-deserved and essentially inconsequential breather, to the point where we're seeing values not available since the bottom of the baby bear market, which was down 19.5% in 2011. Just the fact that the index could even register just an average correction when the energy and commodity sectors of the market are getting murdered, as they have been, is a huge testament, I think, to the inherent stability and value of the rest of the 500 companies in the S&P 500. And get this, the current dividend yield of the S&P 500 is 2.3%. This compares to a yield on the 10-year Treasury bond of 1.6%. Directions of all the lemmings, and you can pick up over 0.5% in current income and get 10 years of earnings, dividend growth, and price appreciation for free. Volatility happens. Volatility is the price we must pay for the extra returns we get for investing in the great companies of America and the world. Volatility is the sudden, significant price movements, down and up, around stocks' relatively smooth upward long-term trend line as pictured here. This is a graph of the annual closing prices of the S&P 500 since 1941. the first thing we see when we look at this graph is that the overall trend in the market is up. Goes from average line, that's the red line right in the middle, is the average line over those many years. The green lines represent out of, very high or low deviations from the average line. 1941 down here, were priced at $11. Today, they're up here at $1,822. That's 165 times that the market has gone up. And that doesn't even include the growing dividends that are paid to you every year. The simple idea is that this chart is trying to convey is that the principal risk of investing in stocks is that the chance you will lose money holding them has historically declined and ultimately disappeared with the passage of time, because the stock market has temporary interruptions, but it's in a permanent uptrend. And that's a statement of historical fact. That's not an opinion. That's the chance that you'll lose money holding them has historically declined over the years. If you look back, if you look at this chart on this page, it illustrates all the 1, 3, 5, 10, 15, 20-year periods from 1926 through 2011, and the percentage of those periods in which the S&P 500 with dividends reinvested produced a positive return. So you can see that 1 year, 752 of the 1 year periods, the 12-month periods, out of 1,021, 74% of those periods were positive. For 3-year rolling periods, it was 82%. For 5-year, the green here, it was 87%. For 10 years, it was 94%. For 15 years, it was almost 100%. And then for a 20-year period, every one of those 20-year rolling periods in the stock market were positive. Every single one. The total value of the shares of the great businesses will go down when the economy contracts, but this is critical. It's never, ever stayed down, and the advance is permanent, like I said, and the declines are temporary. But I also know, as Professor Jeremy Siegel from Wharton said in his book, Stocks for the Long Run, he said that fear has a greater grasp on human action than does the impressive weight of historical evidence. So here's another real-time measuring stick that we use to determine that it is more or less risky to begin investing right now in stocks of great companies. What you're looking at here, this thing that looks like some kind of electrocardiogram, is basically the EKG for the stock market. This chart measures on a daily basis the percentage of the S&P 500 index stocks that are trading above their 50-day moving average. When the majority, or almost all of the stocks, are trading above its 50-day moving average, up here in the red, we say that is the red zone, and that is overbought. The stock market is overbought. Now, when we're down here in the green zone, when very few stocks are trading above their 50-day moving average of prices, we say that the stock market is extremely oversold. So let's look at positions here since 2008. Back here, we have only 1%. This is in October 2008. Only 1% of the stocks, that's 5 stocks out of 500 in the S&P 500, were trading above their 50-day moving average. When was this? This was October 2008. This was at the time, was the low in the bear market that we just went through. Then here we are in March of 2009, we had 5%. We had 5% of the stocks in the S&P 500, that's 25, trading above its 50-day moving average. And then we had 5.4% in July of 2010, another oversold condition. And then we only had 0.4% in August of 2011, which I term as the baby bear market, because we weren't down the critical 20%, but we were down about 19.5% that year. And you can see that only 2 stocks in the entire 500 of the S&P 500 was trading above its 50-day moving average at that time. Then we jumped all the way to the 4.6% back in August of last year, and then just recently, the stocks had ticked to where only 9%. So 9%. So it's a buy signal, we consider, once they get that only less than 50% of the stocks in the S&P 500 are trading above its moving average. So here what we do is I'm going to overlay for you guys the stock chart, and that's what this is. This is these red and green ideas here. This is the actual prices of the S&P 500, and I still kept the bottom half, the periods of time when we would signal a buy. You can see that all these signals of buy, except for the very first one in October of 2008, which was right before the election, that we only had to endure a 10% downdraft until the signal panned out. But anyway, every signal after that, during this bull market, the 5% in 2009, if we bought then, we would have had an 83% return up until the next high. If we bought at the next signal in July of 2010, we would have got a subsequent 36% return in stocks of great companies. Here, the 0.4% in August of 2011, when our debt was downgraded by S&P, when the world looked like it was coming to an end for the 100th time in my career, we would have got almost a doubling of stocks up until May of 2015 up here. And then last August, if we bought then, what we did was we put money in the stock market then, we got a 13% return. Who knows with this last signal what it's going to be when we reach the next near-term high, but the odds are very, very good that when we start to put money into the stock market now, that we're going to get very good subsequent lifetime returns. You still may be wondering and saying to yourself, but David, the stock market is way too risky. Buying stocks is too risky. I'm too close to retirement, or I'm in retirement. I should have fixed income investments, or I should be diversified into commodities or other things. And that's exactly what the wolves of Wall Street want you to think. To think that investing is a very complex thing, a choice among all these different kinds of instruments. It's a maze, and you need them to pay them hundreds of billions of dollars a year so that we, the investing public, can navigate through the maze. It's simply not true. Hear me loud and clear. Investing is simple, and it also can be easy. For instance, did you know that there are only 3 kinds of investments you need to know about? Period. That's it. Just 3. First, there are fixed income investments like bonds, savings accounts, or certificates of deposits that you pay a fixed amount of dollars for a contractual period of time. Second, there are no income investments like oil, gold, copper, and other commodities, or collectibles like art or stamps or coins. These never pay any amount of income, no interest, and no dividends. They're not even investments really at all, since there's no way to value these no income investments. It's the greater fool theory. You simply hope that the next fool will pay a higher price than you paid for it. That doesn't seem like there should be something in your retirement plan now, does it? But that's what they tell us we should diversify into. Then there's the third kind, the only kind that we recommend. Those are rising income investments, which are the only investments that we all need to worry about. These are productive businesses or shares of those productive businesses, and or real estate like farms or office buildings. Those are productive real estate. Business produces profits from which dividends are paid, and real estate yields rents that rise sometimes with or above inflation. Both of these kinds of income investments tend to rise in the aggregate over time. Don't be a greater fool that you need to diversify into gold. Be an owner, not a loaner. Own shares of great businesses and leave it to the banks and insurance companies to be the loaners to governments and corporations. Remember, owners get rich, lose to inflation and to taxes. So here we have the average returns for large cap stocks like the S&P 500, the 10-year Treasury bonds, and the 3-month Treasury bills for the last 87 years per year. So owners stocks basically get about a 10% average annual return per year. Loaners to the government and the 10-year Treasury bond get a 5% return on average for the last 87 years. And loaners to the government for a very short period of time, sometimes called the risk-free rate, has averaged about 3.5% over time. Broadly speaking, it says that over this very long and very varied and very meaningful period of time, the owners of stocks got paid nearly twice what the loaner did. But wait, those are what's called nominal returns before inflation. What about real returns after inflation, which is the only meaningful measure of long-term returns that we care about, since it's the only one you actually earn. It's the only one that will keep up with inflation, so that when you're in retirement or in your later years, that your purchasing power, your income from your investments will actually keep up with the cost of living rise. So inflation over those 87 years has averaged about 3 percentage points over that whole time. So this graph here, in this pattern of returns, backs out the 3% over time, and you can see that stock owners after inflation have averaged 3.5 times. That's 7 over 2% after inflation have averaged 3.5 times what loaners get over the 87 years. But wait, one more minute. What about taxes? Well, if I take taxes out of the whole equation, I make the assumption that on average a person will pay about 30% of income taxes on their investments over that whole period of time. Yes, it's an average. It's not a bad one, but I guarantee it, there's sometimes it's less and sometimes it's more. But on average, let's use 30%. And what happens is, now it gets even worse for the loaners. It turns out that owners get 8 times what loaners get over that 87-year period. In fact, loaners after inflation and taxes over that period earn nothing. Sometimes they earn less than nothing. That means that you will run out of money in retirement. About 2.3%. That's the dividend yield on stocks. 10-year bonds right now in the marketplace on my Bloomberg, that's the no-risk Treasury rate, average about 1.6 rate of return. And bank certificates of deposit up here, what you're looking at here is, I took this off the internet the other day. This is the Bank of America's advertisement for their standard term certificate of deposit, okay, where you give them $1,000 at least, and for 10 years, you will earn a whopping 0.15% on your certificate of deposit. So that's right. In the banks, before inflation, before taxes, you get a whopping 0.15% return in the banks. Or so year retirement to have enough money so you don't live in poverty going forward. So the answer to the question of what stock, so how do I do it? The only way I know how to do it is mutual funds. Okay, what I'm telling you is that mutual funds are not your answer, and the reason for that is you don't invest in stocks or stock mutual funds because mutual funds have too many layered fees. It's a way for Wall Street to suck out your returns so that they can benefit from it, not you. What you've got here is just a chart of all the types of fees that you get when you buy your average actively managed mutual fund. First of all, you pay your financial advisor something like 1% per year. Then that financial advisor recommends some kind of mutual fund or money manager. And that mutual fund pays about 0.4% per year in marketing and distribution fees. You pay that as the shareholder of the mutual fund. Isn't that incredible? So that they could sell the mutual fund and make money off of that. You pay that. So that's a 0.4%. You add it on to the 1. And then there's brokerage commissions within the mutual fund. When they do all their buying and selling and all their buying and selling, they might get free Yankee tickets. But let's face facts, all those brokers and all those people, they are charging you. It comes out of your return ultimately another 0.7%. It's been estimated that the average actively managed mutual fund trade way too much, and it costs you in brokerage commissions. You don't see it, but it does in the end, 0.7%. And then there's sales commissions on the actual shares of some of these funds, and they're split sometimes between 2 and 8.5%. I won't even include those in there. And then if I add another 1% for the advisory fees, that's the financial advisory fee. That's the thing like you would pay somebody like me to do that. That's about 1% a year too. So in total, you pay about 3% per year if you buy stocks through the wrapper that's called a mutual fund. It's actually very hideous. Here it is, easy for you to see. 3% if you buy the typical way in mutual funds. 1% if you do it in an advisory account, what's called a separately managed account. That's the only accounts that we offer. You can own stock in your own account. I manage the stocks for you, and it only costs you 1% all in. No brokerage commissions, no other fees, nothing hidden. It all costs you 1%. Let's see what that impact does to you. What we have here is you can go on our website, and you can see for yourself the difference between investing in a Value Line Partners, one of our separately managed accounts, and a mutual fund company. It's a calculator that you can get right at www.valueline.com/calculator. Now, you got to write that down because you want to go to valueline.com because you want to actually play with this. It costs you nothing. You don't even have to give me your email address right now. All you do is you put in your starting investment. Let's call it 0. Let's say I start at 0. I'm just starting working. But I'm going to put away $5,500 a year into an IRA. And then at the current age, I just got out of college, and God willing, I got this job. Let's say I'm 21 years old, and I desire to retire at the age 68. So let's see what that calculates into. At 9% a year, I'm sorry, at 7% a year, okay, by the time you're 68 years old, out here, you're going to have $1.9 million. That's where the calculator tells you down here, $1.876 million. Okay? No, I'm sorry, right here. The average mutual fund, the 7% return. That's the 10% you get on stocks minus the 10% you get on stocks minus the 3 percentage points that you have in mutual funds. You get a 7% return on average right here. And that's $1.9 million if you save $5,500 a year and you compound that out to 68. Hey, that's not bad, okay? And a lot of people will be able to retire on that $2 million, okay? That's not bad. But let me tell you a stark difference between that lousy 2 percentage point difference between the 7 and 9% that you can on average, if you just got the average returns of stocks over that whole period of time, in one of our accounts, it's something you can control, you will end up with $3.8 million at the end, and that's a difference of $1.9 million. Where did that $1.9 million go if you invest with Wall Street? That goes to them. That goes to the portfolio managers, to the brokers, to the financial advisors, to all the people that are supposed to giving you financial advice, but are also the ones that are selling you that whole bunch of complexity, and that costs you $1.9 million. I can guarantee you that you will have a much more comfortable retirement if you can save $3.8 million than if you only had $1.9 million. That $2 million will make a big difference in your lifestyle going forward. So I promised you, here's 3 things to do right now. Okay? I want you all to consider increasing your 401k contributions and you move into stocks. I bet that all of you that do have 401ks or 403bs, some kind of savings vehicle at your employer, okay, I bet that they give you an allocation or a menu, and you have to choose where you put it. And sometimes they have things like, they'll say, this is less risky, this is more aggressive, and of course, with your retirement savings, everybody wants to be less aggressive and less risky. So I probably, from what I have seen in my experience, most people will have a good chunk, a good percentage of their retirement savings, their 401k plan, in what they call less risky. What that stands for is cash or bonds, money market funds and bond funds for income purposes. And the reason why you all do that is because you don't know what you just learned usually. So most people have in their savings, they'll have allocations to cash and bonds. And here's a great thing. Now, when stocks are down, is the best time to move that cash, move those fixed income investments, move that into stocks. Do it now. Do it as soon as you get to work. If you're at work right now, call down to HR and see if you can't figure out how to change your allocation for all your contributions right now. Make sure they go into stocks. And if you want, call me up and I'll be happy to take a look, or you can read me over the phone what your allocations choices are, and I will tell you exactly what to do, where to do it. And you don't have to be a client to have that. I'll just do that for nothing. Second thing I want you to do is invest cash you have maybe in a checking account that's in excess of emergencies, or maybe a lot of people just got paid a bonus, so their cash is sitting there in a cash account. And maybe a lot of people are paralyzed because they see all the volatility in the market. What I'm telling you to do right now is any cash that's above your emergency fund cash, and everybody should have an emergency fund for cash, you got to invest it right now in stocks of good companies. The best way to do that is not through mutual funds, not through a broker that's going to sell you some mutual funds. If it has to be a broker that's going to sell you mutual funds, make sure it's the lowest cost available. That's usually some kind of Vanguard index fund. But whatever it is, get the exposure out of cash, out of fixed income, and put it in rising income investments, that is shares of great companies in a diversified portfolio, and that means get it into stocks. And do that today as well, or over the next couple of days. And then the last thing I want you to do is take this opportunity to consolidate your old 401k plan. Take your old 401k plan, and a lot of you have that. I see this so many times with a lot of prospects that I have, a lot of new clients. What we end up doing is taking their old retirement plan money that they have at 2 or 3 or 4 other jobs that they've had over the years, and they still have them sitting in their old retirement plans at their old employers. And the problem with that is, I can guarantee you that they probably have layers and layers of fees. You haven't been changing your allocations. You're probably under the old mindset that that's retirement money. So a lot of that money has probably been earning the low interest rates that we've had over the last 10 years and look to still have over the next few years. So the best way to do it is take control of your retirement funds that you can. And then you can allocate your IRA to, say, stocks directly in one of our accounts, for instance. Or make sure you consolidate it into one account so you have control over the allocation and you have control over the money, especially in case of emergency or even for estate planning purposes. It would be nice for planning purposes to have it in one account, and with that account, you can control the costs, because you decide, you can control the trading, and you certainly can control the allocations. So those are the 3 things. Consider increasing your contributions to stocks in your 401k plan. That's the percentage that you put into what they sometimes term as risky investments. They're not risky. And if you guys want me to help you do that, give me a call. Invest your cash that you've accumulated now, that's sitting there that you're maybe afraid to do because you see all the scary headlines in the stock market. And then third, consolidate your old 401ks into one rollover IRA. And those are the three things I want you to do now, and then I want you to consider, a couple of other things. I want you to come in, and I want you to consider coming in, sitting down with me, having a cup of coffee. We'll sit for about 15 minutes, and I can give you that second opinion. It does no harm. It's the easiest way for you to actually do something. I'm not going to change everything that you're doing right now. And if at all, you know, who knows? You know, when the markets turn as volatile and confusing as they have been over the last couple of months, even the most patient of my clients and most patient of my investors, they question all the time. They question the wisdom of the investment advice that they've been getting. So many times clients or prospects come to me and they ask me, they say, you know, can you just take a look at this? What am I doing? You know, nobody talks like you do in terms of, you know, rising income investments. Nobody simplifies it. I don't get these reassuring calls from people when the market's going crazy, and I'm not sure they're doing the right thing for me. So the best thing you can do is get a second opinion. So we'll sit down, we'll have a cup of coffee, and I'll give you that second opinion. And checkup that we call it. Again, it's just 15 minutes, and what we do is we'll sit down, I'll ask you to briefly and just broadly ballpark your financial goals, and I'll take a look at your investment statements, your investment portfolio, and I'll look and I'll say if your investment portfolio is adequate for doing exactly what you think your broad goals are, I will tell you so, and I'll send you on your way gladly, and the coffee's on me. But if I find and will make some recommendations, I'll make some recommendations, and you don't have to take them. You don't have to act on them. There's no obligation at all. It's all free of charge, and I'm willing to sit down with people to give them a second look to see what else they could be doing or maybe what else they should be doing. So either go to valueline.com/go to set up online or in-person checkup, or you can call me directly at 732-800-2375. Here. You said that the causes of the market turbulence are not that important. Well, that's not exactly what I didn't say. I said that the causes of the market turbulence that's going on right now is not that important because I'm not saying it's not that important. It's important, and that's my job. My job as an investment manager is to figure out, you know, what's causing it, and I have plenty of models and indicators to tell me that. But your job as a saver and investor, the real question is not that. The real question is not what is going on in the stock market, not all the financial pornography that's out there on CNBC. I would recommend that people don't even watch that stuff. Don't even read about the stock market. I'm the expert. I've been in the markets for 35 plus years. I've seen ups and downs and all around. And all that matters to you is that you have a financial plan and that you're invested in the right types of investments. In this case, rising income investments, because rising income investments are the only thing that matters. So the fact that we have turbulence is not, it's not that what's causing it that matters, because we've had all very kinds of reasons over the last 85 years of the market going up and down. We've had wars, assassinations, we've had financial meltdowns and panics. But the thing that is the most important is that the reason why we get excess returns by buying stocks is because of that volatility. So we have to learn to embrace that volatility. So that's the question. Yeah, I'm not so concerned on this call or even with my clients, and most clients don't even ask me anymore, what's causing the volatility and where's the stock market going to go in the next year? The answer is it doesn't matter. All that matters is how we react to the volatility. And as you could tell, way I want you all to take away from this is react to the volatility with the thought that this is an opportunity now to change your behavior so your lifetime returns are better than what they were before the volatility. Take advantage of the volatility the same way that Warren Buffett takes advantage of all the volatility. Okay, and then I have another one from a guy named Steve. He says that we have all our savings in an IRA rollover. My wife and I will be getting more when I retire from the company, and all that money is in our 401k plan now. That's the money we have to live on for the rest of our lives, and we have to invest that very, very carefully. So I understand all the stuff that you're telling me about volatility and that stock market returns are higher, but you're not really saying that we should invest our retirement nest egg in the stock market, are you? Well, in a short way, yes, that's exactly what I'm telling you. Because what I'm saying is that everybody conflates. A lot of people conflate the volatility that we're seeing with riskiness. And what I want you to come away with today is that your real risk is you getting to the place that you want to go in retirement and then not having enough income to do the things and to enjoy the life, to live independently, to do the things that you want to do because your investments did not keep up with the ever-rising cost of living. So what you think you need now in income is going to only be a lot more when you finally do retire, Steve. So what I'm saying is, yes, you have to invest in stocks of good companies. That's the only way that your income is going to be sufficient in retirement, so you can, live out, your financial plan and the dreams that you have for all that savings money. So it's really a difference between you're telling me that the stock market is risky and that you're going to risk your nest egg, and I'm telling you, just like Warren Buffett did 2 years ago in his annual report, he said that fixed income investments, bond investments, and safe investments are the most dangerous investments that a retiree could have. And that's exactly what I'm saying. And he's saying it for the same reason. Because after taxes and inflation, you're losing money every year with those investments. So that's why in periods of time like now, I implore people to make the change, to put their cash, the stuff that they have in their fixed investments that they thought was quote unquote safe investments. I'm here to tell you, and so was Warren Buffett, that those are the most risky investments that we possibly could have. Well, we had 2 questions. I went a little bit long. We had some technical difficulties. Those are some really good questions that I picked out. I know everybody, I can see that there's some other questions. So I implore everybody, give me a call, send me an email at david@valueline.com if you'd like. But whatever your questions are, I want to answer them, and I want you guys to take away from this that the period of volatility that we're in now is not risky. It is an opportunity, and it's an opportunity for you to shed the conventional wisdom of the wolves of Wall Street and do the right thing, and do the thing that the great wealthy investors of all time, what they do, they buy down so that they can go up. Thanks, everybody. Have a great day.